Hi there, eToro. It is Monday, and that means it is time to do my weekly review. Let's take a look at what moved the markets last week. Alright, before we begin, just take note this is probably going to be a shorter video because today is going to be a crazy day in the markets, and I want to make sure that I have an eye on things when the markets open in about 20 minutes time. Alright, kicking off with stats. So the S&P 500 over the past year, 12 months, has put in a 32% return, and my portfolio has given a return of roughly 45%. The bug within the eToro charts is still there, so I can't compare and show you that within the eToro charts themselves. In terms of recent price action, so this yellow line, dotted line, vertical line is Monday of last week, and you can see that the S&P 500 and the NASDAQ 100, this NDX, this turquoise line, have had a relatively tough time over the past week, and actually for the past 2 weeks they've been dribbling downwards, and today will be no exception. In fact, today looks like a giant down day, at least when things open up. All right, continuing in the manner that I did last week, I'll start with the United Kingdom. So this is the economic calendar from last week. Let me zoom in a little here for those on their phones. There was a lot of rather bad news out of the UK last week. Probably the key highlights are that the CPI year on year, the inflation numbers, were much higher than expected. On top of this, we also had retail numbers on Friday, month on month, much lower than expected. In fact, there was a contraction in retail sales. So we've got rising inflation, shrinking growth. But I think that there were a number of reasons for this. A few things came together just to create the situation within the UK economy, and I don't think that they will be particularly long-lived. So as I've said before in previous videos, we have a shortage of truck drivers. Truck drivers are the way that things get around in the UK. We also had the travel restrictions within the UK, preventing international travel, not preventing, but making it really, really hard, and in some cases preventing international travel. And we had what is colloquially called the pandemic. So I think a number of these things will ease, and that the UK will be back on track. It was doing very well before this month, and sometimes you get a bad month. We also, I don't have the chart up, but the coronavirus cases in the UK are dropping off quite sharply once again, but schools have reopened. So let's see if there'll be another uptick. I'm not sure. I'm not going to try to forecast what's going to happen in the future. All we can do is deal with the information that we have. Something that's been a little bit frustrating, and this is the way it goes in investing sometimes, is that some domestic stocks that are very strong businesses haven't been doing so well. So JD Wetherspoon's on 1 week performance is minus 3%, 1 month minus 8%, year to date is down nearly 8%. JD Wetherspoon's, for those that don't know, is a UK franchise of low-cost pubs. So you can go there, get a beer, get some food, and everything is priced quite nicely. This business has been run very, very well historically. And in fact, the pandemic, whilst bad for them in the short term, is probably going to be very good for them in the long term. The business is got a very wacky owner. And he says all kinds of crazy things. He was all for Brexit. So, I mean, politically, our views are not aligned. But in October 2020, the company reported its first loss in 36 years. This guy knows how to run this business. So before this, it had a net profit of 102 million. It's also reaffirmed that it has expansion plans. So it used the pandemic as an opportunity to get rid of its worst properties and acquire smaller independent pubs on the cheap, because pubs were closed for a large part of the pandemic. What is also interesting is that Wetherspoons doesn't just rent these pubs, it does rent some of them, but the vast bulk of them are owned. And so this is a lot of rarely good property. They're a large property owner within the UK, and the portfolio of properties that they own hasn't been revalued in a long, long time. And as we all know, property prices have been doing pretty well recently. You can go through the numbers yourself. Obviously, the Brexit effect, the pandemic effect has been very hard on the business, but we know that it's owner-managed It was growing quite well before for a brick and mortar kind of business. Yes, they're carrying twice the amount of debt that they have historically, but who can blame them? We've just been through what we've been through. Yet the share price is down at 1,000 pence. It was at 16, nearly 1,700 pence before the pandemic. They need to pay down their debt, obviously. There's some premium that we will have on the stock because of that. But I believe that the stock price is massively undervalued. I think when we see the new earnings, we will find that they have been operating maybe almost all of their pubs and almost completely full, as well as having a number of new pubs. And I'm looking forward to when they revalue their property portfolio, because I think at the moment their book value is probably much cheaper than it should be. All right, what we also have in the UK is a not natural gas crisis. We have an energy crisis. So there's been a perfect storm of a number of different events that have meant that the prices of energy, and here we're looking at natural gas as one example, have gone crazy recently, absolutely crazy. And so there have been emergency talks with the government and providers to figure out how to solve this, because we're still in a relatively warm part of the year when natural gas usage is fairly low. And as soon as it starts getting cooler, we're going to be in a bit of trouble if the prices are this high. Okay, onto the United States. So jumping back to the economic data, I'll walk through the United Kingdom data first, but the US had almost the exact opposite situation last week. That being that core CPI, so inflation measures, were lower than expected, and that growth, as represented here by retail sales, was higher than expected. So this, it's not reflected in the prices that we saw, the price action we saw in the indexes last week, but this has meant that people are starting to wonder if inflation might be transitory, like the Fed said, and are becoming less concerned about inflation. So if we have lower inflation and higher growth than expected, then we are potentially entering into a Goldilocks economy. It's taken us longer to get there than I thought, but we might potentially get there. And so we saw that reflected in some of the assets that swapped hands last week, although this week things have gone a little crazy, but for other reasons. So despite the positive economic data out of the US, like I said earlier, we saw a bit of green in part of the week, and then we saw a sell-off in the major US indexes towards the end of the week. And this could be for a few reasons. I think we probably are still in the profit-taking cycle after the fantastic run-up that these stocks had in the past few months. We also had the quadruple witching event on Friday, which happens roughly once a quarter. And September, by the way, is traditionally, so statistically speaking, September is fairly weak after the quadruple witching event, although sometimes it isn't. So I think we have other things going on right now that are pushing prices down. I think fears around Evergrande, which I'll talk about in a moment, have meant that US stocks haven't performed as well as they might have, and obviously Chinese stocks have received quite the hammering. So there's no real discernible pattern that I could find in the stocks that were our biggest winners from last week. There's a mixture of SaaS businesses, energy companies, solar companies, automakers, game makers. So at the moment, it's very difficult to make a call if you are trying to invest based on purely macro, which direction the markets are going. I think that there's a lot of assets being juggled under the hood. What I did do last week is I picked up a few new positions and added to other positions. So for example, UiPath is a company that I quite like. I've liked them before they were listed. They're an enterprise software company. They allow you to automate tasks within your business. I didn't like the price after the IPO, which was a bit crazy, but it's come back down to earth, and I think it's pretty fairly valued at the moment. Well, a little bit cheap actually. And I've added to the likes of Activision. So the gaming industry is a massive growth industry and will continue to be that way for at least the next decade. I've picked up some Activision, which had fantastic earnings in their last quarter. They've got a good roster of games that are coming out over the next few quarters. They raised their outlook for the rest of the year, and for some reason the stock has been selling off. So I've been slowly adding to that position. If it continues to drop, then I will continue to add. I also rode the momentum in Cameco because the prices of uranium have been going absolutely crazy recently, and in part, well, this is thought to be because a number of the major producers and also an ETF have been buying up supplies of uranium, driving the price higher. But I think that sentiment is also a large part of why it's just going higher. People buy things that are going higher, driving them even higher. So I rode that wave a little bit. I would quite like to get into Cameco at a more reasonable price. It has dropped off significantly recently, but I will wait a little bit longer, especially because commodities, well, some commodities have been selling off quite hard for the past week or so. All right, and on to China. So today we're approaching the peak fear when it comes to the collapse of Evergrande. I know that the media is making a lot of noise about this at the moment, but this has been going on for a month, maybe longer than a year. It's been a very slow moving thing. Lots of people have called it out, and now it seems as though we are basically down to crunch time. Everyone's worried that this is going to spread through the rest of China and then potentially through the rest of the world. There are some very interesting takes on it. There are some very bearish takes. There are some very bullish takes. There are some takes that are right in the middle of the road. I am always interested in hearing what very clever people have to say, but everyone has a stance, everyone has a bias. So just bear that in mind. Evergrande itself is not doing very, very well. The share price is closed at the lowest level since 2010. A number of other companies within the same industry were selling. I think there were at least two that had sold off up to 80% or 84% in the Hong Kong market. So I'm not going to try to predict the future as to what will happen here. I will be watching it very closely though as it develops. And if I make any changes, it will be based on actual information and not people's opinions. I did mention earlier that the price of some commodities is dropping, notably iron ore. So China is trying to control the prices of certain commodities because the rise in the prices of commodities is driving inflation within China, but also globally. Iron ore is just one such commodity, and I think I have something open here. Yeah. So iron ore in the past week has dropped 5%, in the past month has dropped 23%. Before this, the prices were rallying like crazy, so it's given back all the gains and then some. So I think China's done two things. It's released strategic supplies into the market, but also it has asked certain companies that are iron hungry, or industries that are iron hungry, to start cutting back on their production to bring the demand side of things down. So increasing supply and trying to bring demand down. Some other commodities have kind of caught the sentiment here. So I will be sitting out. I did trade a few iron companies and copper companies earlier in the year on the fantastic momentum that we saw, but it's getting a little bit tricky to make money if you're trying to make it in the short term on these commodities. And finally, onto the coming week. It's going to be a pretty interesting week. So you can see holidays in China, lots of economic data coming out of the US and the UK. The market will be firmly fixed on the Fed speech on Friday. There's an expectation that we will get more details around the tapering of QE, although people are starting to wonder if whatever the Fed's original plan might need to change to accommodate the current global economic climate. So economic data, as I said before, has the potential to move the market quite a lot at the moment because the economy, the domestic economies and the global economies are all wonky, particularly because of supply chains. The Evergrande story is going to probably peak at some point this week, given that a lot of debt is coming due. Is it today or sometime this week? So if they default, we will know about it. So I think that's another thing that is likely to move the markets. And finally, the commodity prices, they are dropping, which is hurting companies involved in the production of commodities. But that means that the materials, at least in the short term, that many companies use to produce whatever they produce, for example, solar companies or wind companies need iron ore, the cost of production will drop. Hopefully for a bit longer than a few days or a few weeks, so that those companies can make a little bit more profit. All right, that's it for this week. The markets are about to open, so I'm going to go take a look and prepare for the day ahead. Speak to you next week. Goodbye.